Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today, as always. Let's talk ESG today. Let's bust some of the most common myths about ESG investing. So before we get into that, let's talk a little bit about what ESG investing is, what it means, just briefly. So ESG investing is kind of a subset of socially conscious or socially responsible investing, or in my case, I kind of call it socially conscious financial planning to encompass the bigger picture. But a lot of times, investors will want to align their money and their investments with companies that are making a positive impact in the world, or at least with issues or causes that they deem to make a positive impact in the world. Some examples are the environment. So, for example, a lot of times investors will want to invest in either mutual funds or specific investments that avoid companies making a negative impact in fossil fuel, or they want to invest in clean energy, or they want to invest in companies that align with social issues that are important to them, such as diversity, inclusion, treating employees well, making a positive impact in communities, board diversity, governance. So these are all things that some investors are focused on and things that are important to them. And so ESG investing is a way to accomplish that by aligning your money with these issues that are important to you. And so the E and the S and the G stand for environment, social, and governance. And so these sort of encompass the general broad groupings of areas that investments can focus on when it comes to making a positive impact in the world. Again, some examples might be, I've already mentioned some environmental examples, but environmental examples are the most common. They've been around the longest, and it's easier to find investments that align environmentally. But social and governance are also becoming more mature. And so, for example, a lot of times investors will look for mutual funds that invest in companies that have diverse workplaces, anti-racist, anti-discrimination policies that are strong and developing. They will focus on companies that have a priority to make sure that women are represented in leadership and on board positions, and really making efforts toward a more equitable and inclusive workplace and business environment overall. So that's kind of a very short, non-comprehensive kind of summary of ESG investing for those who may not be familiar with it. So for those who are familiar with it, that might be familiar. Obviously, I kind of said that already. That might be something you already know about, but there are some myths out there among people talking about ESG investing. And I want to talk about some of those myths today. I want to talk about, I've got 7 or so myths here that come up frequently when talking to people who are curious about ESG investing, or maybe aren't as familiar with, or maybe you are familiar with it, but have heard these myths come up and are interested in kind of unpacking it a bit. So we're going to talk about some of the most common myths I hear about ESG investing and unpack a few of these. So the first myth we're going to talk about is that ESG means sacrificing investment performance. So this is, some people say, well, if I'm focusing on investments that are making a positive impact, that's going to be the priority, and I have to sacrifice investment returns or performance as a result because I'm kind of picking one or the other. That's has been found to be not necessarily true. In fact, there's a couple, more than a couple, there's quite a few research studies out there that address this, and a couple that I'm going to share today. One of them is from the MSCI ESG Research LLC organization, which kind of studies this stuff and is one of the leading organizations when it comes to ESG analysis and research. They found that between May 2013 and November 2020, companies with top-tier ESG ratings had an active return of 1.31% over the entire universe of funds. So they found that there was definitely indication that these high-rated, high-scoring ESG-focused investments actually did outperform when compared to the actual general universe of investments. In fact, also a separate study, which is from the CFA Institute, showed that people are paying attention to this. Financial professionals like me are actually noticing this and integrating that and implementing this. So a separate study, again, from CFA Institute, showed that 35% of investment professionals invest in ESG to perform, or I'm sorry, to improve their financial returns. So they're specifically doing it in an effort to improve financial returns. So there's a lot that can be said about this. There's a ton of information that could be shared about this topic. But one thing to think about when you're looking at performance and ESG investments is that ESG factors are risk factors. There are cases where companies you've heard of, big famous companies, have had PR disasters as a result of negatively impacting the environment, or negatively impacting society, or negatively impacting their workers. So ESG risks can cause problems for values of companies that are traded as equities. So if a company has a negative impact on the environment, or on society, or on their community, and this becomes a PR issue, then that can cause stock prices to decrease. It can cause issues and valuation issues. And so more and more financial professionals are realizing that ESG issues are not single dimensional. There are many dimensions to why ESG analysis makes a lot of sense when looking at investments. So these in turn can affect investment returns and the performance of the company's stock. So again, it's not necessarily true. And in fact, many cases it is, we're seeing that investment performance is actually higher in some cases when investing in ESG focused investments than their counterparts. So this myth of ESG sacrificing investment performance has not been necessarily proven true. So that's one myth we're going to talk about today. Next, ESG funds are more expensive. That's the second myth we're going to talk about. So again, so much to say about each myth here and each topic in general. These could be whole separate episodes, and they may be at some point, but there's a big focus these days on the cost of mutual funds. There are big, well-known investment companies. I'm sure you know of some of them, especially one in particular that has made a big effort to focus people on fees and on the cost of funds. And this has gotten a lot of people really kind of obsessive about finding the lowest cost mutual funds. And therefore, any fund that has fees higher than they deem appropriate, they just don't even consider. It's just off the table. And so fees are kind of a singular focus to a lot of people. I'm not one of those people. To me, fees are not a singular focus. Fees are part of the big picture, and we should pay attention. But ESG funds can sometimes be more expensive from a fee standpoint because a lot of them are actively managed. And actively managed funds tend to have higher fees than their passive counterparts because there's more management happening, there's more activity, and there's more hands-on management of the fund. So that makes sense. But first of all, the fees aren't that different when it comes to comparing actively managed funds that are and are not ESG. You see a pretty reasonable comparison. And second, when you're looking at performance, one thing to keep in mind is typically when you're looking at performance numbers on mutual funds, for example, you're looking at performance net of fees. So when you line up the historical performance from an apples to apples standpoint, when the fees are subtracted, you don't really tend to see these massive variations. You see that ESG funds are pretty much on par when you take all things into consideration, including the management fees as well as investment returns. Always understanding that past performance does not guarantee future returns. I want to say that out loud, but this myth of ESG funds being more expensive just simply not true. You can find expensive funds that are ESG. You can find low-cost funds that are ESG. Same with non-ESG funds. So definitely a myth. Next myth. ESG is just about avoiding fossil fuels. A lot of people think, well, ESG investing is simply for environmentalists. It's really just about investing in companies that aren't producing fossil fuel waste or aren't participating in fossil fuels. It was kind of true-ish at one point. That's kind of where things started a lot of cases. But now there is a vast kind of multidimensional landscape of what ESG really means. Environmental is the E part of ESG. Environmental can be things like avoiding fossil fuels, investing in clean energy. It can be avoiding deforestation. It can be a number of issues related to the environment. But the S is becoming much more prominent in investors' kind of worldview. And again, the S stands for social. This can be things like, again, how the company treats its workforce, company benefits, empowering individuals and their teams, how companies address racial inequity and discrimination and sexual harassment and things that affect marginalized communities. And so that's becoming much more important from an investor standpoint, is how does this company interact with society to benefit and lift up those who are marginalized, LGBTQI plus individuals, again, racial diversity. So all sorts of things that the companies can do to create inclusive, diverse, empowering, equitable workplaces. And the governance part also addresses things like board behavior, transparency when it comes to political contributions. Again, what sort of representation you have on company boards, gender identity diversity, racial diversity. So there is a broader mix of issues that kind of make up the universe of ESG, going much beyond just fossil fuels and environmental concerns. Next myth: ESG is trendy, but no one's really doing it. Some people like to say that ESG is just sort of a trend. It's just sort of a thing people talk about and pretend to care about, but no one's really doing it. Well, that's actually not true at all. So ESG interest has risen pretty much exponentially. So, global ESG assets under management have grown from 6 billion in 2015 to 150 billion in 2020. So a massive growth in interest in ESG investing. So that myth is simply not true. Next, ESG investing means eliminating entire sectors. So some people say, well, if I'm focused on ESG investing, it means I have to eliminate certain sectors, energy sectors, et cetera. It means I have to have a very one-sided, non-diverse portfolio. Again, not true. And this is really not true because there are multiple aspects that make up approaches to ESG. There's integration, there's value in screens, there's thematic, there's impact. For example, integration is basically saying, hey, we're going to look at portfolio diversification and financial factors first, and then we're going to go back and attempt to integrate ESG-focused investments in the big picture as part of the plan, but it's not necessarily the overarching or overriding factor. So that's integration. Values and screens. It can be, hey, we can look at certain companies and certain funds that screen out certain things that are problematic or things we want to avoid, or that promote certain values. And we're seeing much more diversity and choice among available investments that fit certain values and screens. Impact investing, we can go the other direction and say, well, we're not just necessarily going to avoid problematic issues, but we're going to invest in mutual funds, for example, that do proxy voting that align with my values. So, one example is mutual fund families that are built around ESG will often have a lot of engagement with the boards of companies that are in their mutual funds. They will actually, be in communication with these boards and create shareholder resolutions and do proxy voting on behalf of their investors to vote for issues that promote environmental consciousness, social consciousness, et cetera. And so that is a more impact-focused way of ESG investing. So there's a lot of ways to approach ESG, and there's no one-size-fits-all necessarily for every investor. And so it doesn't necessarily mean just eliminating the entire sector that may be problematic. Next, and second to last, ESG investing is just for millennials. This kind of goes with the trendy myth as well. A lot of people think, well, ESG is just for young people. Millennials care about the environment, but it's not as important to others. That's kind of a funny one. Not true at all. ESG has risen in popularity among the entire investor population. The general population is pretty much on par with millennials now when it comes to interest in ESG. So we're seeing a big shift where people of all ages and all backgrounds are becoming aware of the ability to invest in a socially conscious way with ESG investments and learning more about how to do it. All right, so finally, this is one of my favorites. The last myth I'm going to discuss today is all you need to look for is the letters ESG in the name of the fund. So a lot of people say, well, if I want to invest with impact and do ESG investing, all I really need to do is just look for a fund that says ESG in it. And I'm not going to name names, but there are plenty of funds out there, a lot of index funds even, that say, hey, this is an ESG fund. And people think, well, that kind of checks a box. I can just kind of check the box and say, well, great, I'm doing ESG investing. Easy peasy, right? You'd be surprised at when you actually dig deeper and do a more critical analysis of these funds, how different some of them are from each other and from other types of funds that are perhaps more impactful. So there is not an easy way necessarily to just look at the fund name and say, well, it's ESG. So, I found ESG funds, for example, that are, very popular index funds that have a very poor score when it comes to gender diversity, for example, in the companies they invest with, or deforestation or prison industrial complex. There's all sorts of issues where they may focus on maybe one aspect and they call themselves ESG because of that aspect. It's very thematic. Maybe it's environmental only, or they are just simply doing a casual integration approach, but don't necessarily go too far in exclusions or don't make an impact necessarily. There's no engagement. So there are there's a lot of variation among ESG funds. So it's not enough, in my opinion, just to look for ESG in the name of the fund. To me, it means going much deeper and doing a more critical analysis of what's really in that fund, which companies are there, and what sort of advocacy and impact is happening from the fund managers itself. To me, that's where I like to go deeper when it comes to ESG. So those are, looks like 7 myths we discussed today when it comes to ESG investing. And it's no secret, that's what my firm is all about. I really specialize in socially conscious financial planning and ESG investing. So I tend to attract those who care about this stuff. So that's kind of why I like to talk about it. So if you have any questions about ESG investing, this is not comprehensive, of course. This is just a kind of a quick walkthrough today, but there's a vast universe of, how to think about ESG investing, how to invest in a socially conscious way. And that's what I do for my clients. So as always, if you would like to reach out and talk about it more, definitely feel free to reach out. Let me know. You can find me on my website, as always, which is elevationfinancial.com. And you can just send me a note through my website there or book a meeting online. And there's a free discovery session we can do. I call it a free money session, a complimentary money session. And you can ask questions and we'll talk about whatever you want. So with that, thanks for joining me today. Have a great day as always. We'll see you next time.